Hello everyone and welcome to this episode of Ignition Time. In this video, I'll talk to you about the 5 biggest mistakes to avoid in the stock market. I have to be completely honest with you. I'm going to not hold back in this video. I'm taking the gloves off and I'll be completely honest, in many cases, brutally honest, because I do want to help our viewers and subscribers. I see a lot of people making a lot of mistakes out there, and so in this video I'm going to talk to you about my management and my experience managing my own personal stock market portfolio, which is in excess of $10 million, and I'm going to tell you exactly how I was able to build up the portfolio and help you build the correct strategies and correct foundations to manage that kind of wealth by avoiding the biggest mistake that most people make. So let's get started. We've all heard of Jim Cramer from CNBC. There he is. What's up, Jim? Now I have to tell you, I believe Jim's knowledge is excellent and I believe that he's sincere in what he does. But like I said, this video was going to be a no holds barred video. This is not a criticism of Jim Cramer, but I think the daily stock market approach, the jumping from one stock to another or trying to keep track of daily trends, that approach is absolute. Yes, that's right. You heard me say. And the reason I said that is because the biggest mistake you can make in the stock market is to try and get in and out of stocks quickly. In the short term, the stock market is designed to essentially get rid of the weak and keep the strong. But if you can hang in there with the stocks that you believe in, with the high conviction stocks that you research and that you buy at the right price, then you're going to be able to win over the long term. This entire AMC situation, the short squeeze situation, monitoring the market every day when it opens, monitoring the market every day when it closes, is bad for your emotional health. And it is not something that will allow you to win in the long term. So let's get started with the 5 major mistakes that I've seen others make in the stock market. The biggest mistake is ignoring valuation. I was actually on a Zoom call with a bunch of investors, and one of the young guys on the call said, I don't even look at valuation. I'm a momentum investor. I invest in stocks that have a high amount of momentum. Folks, I think that's the most ridiculous thing I've ever heard, because I don't even know what a momentum investor means. I believe that you should be able to read a company's balance sheet. I believe that you should be able to read a company's 10K. I believe that you should be able to understand what the CEO's vision is for the company. I believe you should participate in earnings calls, conference calls. You should know how much money the company makes, what their profit and loss looks like, how many shares outstanding, and then you should be able to essentially analyze what that stock is worth. In other words, you should be able to understand the valuation of a company, and you should be able to say, okay, this stock is worth this much. If you ignore valuation and you just pick a stock because some other guru is picking it or because you feel it's a good stock. I mean, I've heard people say Airbnb is cheap. Well, I've heard people say Tesla is cheap. Well, folks, if you look at the price earning multiple, and if you take a look at many other measures, by the way, this is not just about the PE ratio, you'll be able to essentially evaluate whether the stock is overpriced or underpriced relative to how much money they are making now and relative to how much money they are making in the future. You cannot win in the stock market by overpaying for a stock. You might make some short-term profits, but you will get your handed to you if you overpay for a stock. Yes, I said that. You will get your handed to you if you overpay for a stock, and you'll find yourself eager to get out of the stock. And when the stock plunges, and inevitably all stocks tend to plunge, there tend to be major corrections in the stock market. I do believe that there'll be some sort of a major correction sometime this year. When the stock plunges, you'll panic, you'll sell, and you'll lose a bunch of money. I have seen cases of individuals who've lost hundreds of thousands of dollars in the meltdown that occurred in the technology sector. And this is a horrible way. The Cramer approach, the approach of watching the stock market in the beginning of the day, the end of the day, is a horrible approach to investing. It is an approach that is going to drain you emotionally. And what that's going to do is make you essentially kind of like a bouncing ball. You'll be like a rabbit jumping from one idea to another instead of being a seasoned, intelligent, strategic, long-term investor. I want you to learn this and I want you to implement this. Otherwise, Otherwise, you're going to end up learning it the hard way. And for many of us seasoned investors watching this video, I'm sure you've learned the hard way and you've learned from your mistakes. So you know exactly what I'm talking about. Now, the second approach that I'm really concerned about is blindly following other gurus. When you blindly follow someone else, again, I told you that this was going to be an honest video. It means that you're too lazy to do your own research. It means that you don't want to put in the effort to value a company. And by the way, I'm saying this because I care for our viewers and subscribers. This is not meant to be critical. This is meant to be some tough love. It's meant to be brutally honest. So if you're among the 1% that's going to freak out that I'm blaming you, don't get defensive. I'm trying to help you. If you blindly follow another guru without doing your own research on the company, you are trying to hide your inability to do research or your unwillingness to do research, and you're trying to be lazy, and you will eventually lose money. Put in the time, put in the effort to research a company in detail so that if something happens, you know what to do. You've done the research and you know at what point you need to exit. Do not blindly follow other gurus. Now, I'm not saying that these gurus are misleading you. What I am saying is that the gurus have probably done their own research. If you do your own research, you may not agree with them, or you may find that their research is faulty. Folks, some of the biggest investors of all time make huge mistakes and essentially go out of business. So don't follow someone else blindly. If you see them doing something, do your own research and then come to your own conclusion and say, okay, I'm going to copy this strategy, or you know what, nah, I'm going to go in a different direction. Do your own research. Do not blindly follow other gurus. That's why I'm emphasizing the word blindly. Now, the third point, and this really concerns me, no short-term guardrails. You've got to have a precise strategy that, let's say your stock drops by, let's just say 5%, 10%. You have an order to exit the stock, so you minimize your losses. If you're doing options trading, you've got to have a precise guardrail. I'm trying to collect this much money in this week or in 2 weeks so that my annualized return is so and so. So you've got to have some precise guardrails in place if you're going to be getting in and out of stocks over the short term. By the way, in case you haven't figured this out already, I don't buy and sell stocks. I buy stocks and then I hold stocks for the long term, and then I sell deep out of the money options, to essentially covered calls, in order to collect cash flow from those stocks, and I hope never to get called away. I'm simply trying to milk my stocks and generate my own dividend and try and reduce the cost basis of my stocks. That's what I try and do. So I have short-term guardrails in place. For example, I own Apple. My goal is to sell covered calls and collect right around 25 cents a week on all my Apple holdings. When I do the math based on my cost basis, 25 cents a week works out to be $1 a month, and that works out to be $12 over the course of the year. That for me amounts to a 15 to 20% rate of return on my current Apple holdings. So I sell a covered call for 25 cents, and it's usually far away from the current stock price, because 25 cents is not a lot of money. But then I know that all I need is 25 cents. I don't want more than that. I don't want less than that. So if you're strategic, you should be able to have short-term guardrails to increase your returns exponentially over time. Number 4, no long-term goals. A lot of investors I talk to are like, oh, I just want to make money in the stock market. Well, what does that mean? Do you want to go from $100 to $101? You made $1. Making money is not a goal. You've got to have a very specific goal. You've got to say, all right, I'm trying to gain 20 to 30% by way of appreciation, make an additional 10 to 15% by way of short-term options trading, selling covered calls, or selling puts on stocks that I want to own. You've got to have a clear strategy. There are also tax implications here, because short-term capital gains tax is at your federal tax rate and long-term capital gains tax is lower. So when possible, you want to hold on to stocks for longer than a year, which, by the way, goes back to the original concept of long-term investing. You need to know at what price you want to buy in, because if you overpay for a stock, you're going to be in big trouble. And finally, I mentioned overpaying. The final point that you need to avoid, this is a big mistake, is over leveraging, being in margin. Now, margin is not necessarily a bad thing. I'm in margin right now. I use a broker where I can borrow money at 1%, which is ridiculous. If I'm able to borrow money at 1% and I can make 20, 30, 40% returns a year, which I do based on how I handle my holdings in the stock market, it's a no-brainer. You can grow your wealth with other people's money. But if you don't know how to use margin, and if you work with a broker who could margin call you because you don't understand how margin works, you're going to be in big trouble. please avoid margin if you don't understand the implications of margin. Plain and simple. Also, if you have no experience in stock market trading using margin money, avoid margin. If you've been using margin gradually over several years, you're more likely to use margin money effectively to grow your own wealth. But do not use margin, because if you get margin called, essentially the broker will liquidate your holdings and you could see huge losses, and that did happen with the recent meltdown in the Nasdaq. So that's it, everybody. 5 mistakes to avoid in the stock market, lessons from a $10 million portfolio. Let me know in the comment section below whether you learned something new from this video and what your own personal experiences are. So just to recap, these 5 points are: ignoring valuation, blindly following other gurus, no short-term guardrails, in other words, you have no strategy week to week, no long-term goals, you have no strategy year to year, and finally, over-leveraging yourself and finding yourself in a position where you get margin called. This is an extremely dangerous situation to be in, and I encourage you not to use margin if you don't understand the implications. I would encourage you to be a long-term investor and build your investing muscles over time, because investing is almost like a competitive sport. But the good thing is we are all equal, because it is a meritocracy. Depending on how you handle your psychology and how you make decisions, which is where the short-term guardrails and the long-term guardrails come in, anyone can succeed. But the flip side is you can't walk into an arena with no preparation, which is what happens with many investors. Lose money and essentially take years to recover. I don't want that to happen to you. I want you to build your muscles over time, and hopefully you can learn from these mistakes. Thank you so much for watching. My name is Dr. Nitin Chhoda with Ignition Time. I want you to know that you are greatly appreciated. Please click the like button, please subscribe, please enable notifications. I hope you find this helpful. I really appreciate you. Please click the like button and subscribe, because it helps out the YouTube algorithm. It'll just take you a second of your time. Thank you so much. I'm looking forward to seeing you in the next episode of Ignition Time. Take care. Bye.